Are you tired of watching your money sit in a savings account doing absolutely nothing for you? While inflation eats away at your purchasing power, the wealthy are quietly stacking cash flow every single month. But how? The answer lies in dividend ETFs, specifically, the ones that have consistently outperformed others and created reliable income for smart investors. In today's video, we're going deep, not surface level, but full deep dive, into the 7 most powerful dividend ETFs you should know about. We'll break down what makes them special, how they fit into a real investment strategy, and how the ultra-wealthy are using them to quietly build wealth while the rest of the world sleeps. You won't find hype here. Just raw, researched insight designed to help you make real decisions and understand how to position your portfolio for long-term passive income. So whether you're a dividend rookie or someone refining your income strategy, this video is your roadmap. Let's start with the ETF that quietly became a legend in the dividend world. 1. SCHD, the undisputed dividend growth titan. SCHD stands for the Schwab US Dividend Equity ETF, and for many investors, this is the backbone of their entire dividend strategy. What makes SCHD different? It doesn't just track companies that pay dividends, it tracks companies that have consistently grown their dividends for at least 10 years and also have solid fundamentals. We're talking about return on equity, dividend growth rate, and consistent earnings. With an expense ratio of just 0.06%, SCHD is one of the most cost-effective dividend ETFs available. But don't mistake low cost for low performance. SCHD has been consistently delivering returns comparable to the S&P 500, but with the added benefit of quarterly dividends. Top holdings include companies like Broadcom, PepsiCo, Texas Instruments, Coca-Cola, and Lockheed Martin. Why does this matter? Because these aren't just dividend payers. These are fortress companies that keep paying, even during economic downturns. In fact, SCHD held strong during the COVID-19 market crash and quickly rebounded. Many income investors swear by SCHD because it balances growth, income, and risk. Whether you're retired or just getting started, SCHD provides steady cash flow and is a great core position in a long-term portfolio. 2. JEPI, the monthly payout machine with a twist. JEPI is short for the JP Morgan Equity Premium Income ETF, and this one is different from anything else on the list. While SCHD focuses on dividend-paying companies, JEPI uses an income strategy that combines high-quality stocks with options income. It writes covered calls, meaning it sells call options on the stocks it owns to generate additional income. What does that mean for you? JEPI pays dividends monthly, and those dividends are often well above 7% annually. This makes it very popular among retirees and income-focused investors who want consistent monthly income instead of quarterly. Top holdings in JEPI include Progressive Corp, Caterpillar, Trane Technologies, and S&P 500 equity-linked notes. Now, let's be clear, JEPI is not designed for explosive growth. But that's not the point. Its strength lies in stable, high monthly income and a strategy that reduces volatility. During uncertain markets, JEPI acts as a shock absorber in many portfolios. If your goal is consistent income and you prefer monthly payouts over quarterly, JEPI should absolutely be on your radar. 3. VIG, the Vanguard Dividend Appreciation ETF. If you value stability and long-term growth, then VIG should be on your radar. The Vanguard Dividend Appreciation ETF focuses on companies that have increased their dividends year after year for at least 10 consecutive years. Think about that, a company that can grow its dividend through recessions, rate hikes, and volatile markets isn't just a dividend payer. It's a proven survivor. VIG's portfolio leans heavily toward high-quality U.S. large-cap companies, but with a focus on consistency. It avoids extremely high-yield companies that might be riskier or less stable. This ETF is all about quality over quantity. Top holdings typically include Microsoft, United Health Group, Visa, J.P. Morgan Chase and Johnson & Johnson. While its dividend yield isn't sky-high, usually hovering around 2%. The growth of the payout and price appreciation over time makes it a strong long-term hold. VIG also boasts a super low expense ratio of just 0.06%, which means more money stays in your pocket. If you're younger or focused on growing your income over time, this ETF aligns perfectly with that strategy. 4. HDV, the defensive powerhouse. Next up is HDV, the iShares Core High Dividend ETF. This ETF focuses on high dividend yield stocks, but with a twist. It uses Morningstar's economic moat ratings to filter companies based on financial health and future earnings stability. What does that mean for you? HDV holds companies that not only pay strong dividends, but also have a competitive edge that helps them dominate their industries long-term. Its portfolio is more defensive in nature, meaning it tends to perform better during market downturns. Top holdings often include ExxonMobil, Johnson & Johnson, Chevron, Pfizer and ABB. With a dividend yield over 4%, HDV offers a great blend of income and protection. This is a go-to ETF for investors looking for safer dividend payers that can weather economic storms. Its expense ratio is slightly higher than SCHD or VIG at 0.08%, but still very reasonable for the quality you're getting. HDV is ideal for those who want reliable income with less volatility, and it often serves as a buffer against inflation and economic uncertainty. 5. VYM, the yield-heavy veteran. If you want yield, VYM, the Vanguard High Dividend Yield ETF delivers. It focuses on large U.S. companies with above-average dividend yields, but avoids chasing risky payouts. VYM tracks the FTSE High Dividend Yield Index, which means it selects companies with a strong history of paying solid, sustainable dividends. It's one of the largest dividend ETFs in the world, with billions in assets under management and a huge base of long-term investors. Top holdings include J.P. Morgan Chase, ExxonMobil, Procter & Gamble, Johnson & Johnson and Merck & Company. The dividend yield typically sits around 3% 3.5%, and with a rock-bottom expense ratio of 0.06%. VYM gives investors access to broad, diversified income at an extremely low cost. Unlike JEPI or other option-based funds, VYM sticks to a traditional equity approach. It's simple, predictable, and great for passive income seekers who want minimal complexity. Many investors use VYM as a core position and combine it with more aggressive ETFs to create a balanced income strategy. 6. DGRO, the modern growth machine. Let's talk about a fund that quietly flies under the radar, DGRO, the iShares Core Dividend Growth ETF. This isn't your traditional high-yield play. DGRO is all about dividend growth, focusing on companies that have consistently increased their dividends for at least 5 consecutive years. Why does that matter? Because consistent dividend growth usually signals strong earnings, solid management, and a commitment to returning value to shareholders. DGRO has a strong balance between growth and income, making it a favorite for long-term investors who want more than just a high yield. It's ideal for building income over time, rather than chasing instant gratification. Here's the type of companies DGRO holds: Apple, Microsoft, Home Depot, Johnson & Johnson and Pfizer. Its dividend yield is moderate, around 2.5%, but the real magic happens as these companies continue to increase their payouts year after year. It's about compounding your income stream while participating in capital growth. Plus, with an expense ratio of just 0.08%, it's built for efficiency. It's a perfect choice for younger investors who still have a long time horizon and want to watch their income snowball over decades. 7. JEPQ, the high-tech, high-income hybrid. Now, let's bring in the new star of the show, JEPQ, the JP Morgan Nasdaq Equity Premium Income ETF. This is the high-tech cousin of JEPI and it's changing the game for dividend investors. JEPQ takes top Nasdaq 100 growth stocks and layers on an options strategy using covered calls. What does this do? It generates consistent monthly income even from stocks that don't typically pay dividends. Think about that. You're collecting income from Apple, Amazon, Meta, and Google without them needing to actually pay dividends. That's the power of options-based ETFs. Here's why JEPQ is powerful. It pays monthly dividends. Yields hover around 10%-12%. It provides access to tech growth with income generation. Unlike JEPI, which leans defensive, JEPQ gives you aggressive upside exposure with consistent cash flow. If you believe in the long-term strength of tech, but want passive income today, this is your ETF. And despite its sophistication, it only charges an expense ratio of 0.35%, which is fair given the active strategy and options overlay. This ETF is newer, but rapidly gaining popularity among income investors who want growth exposure. So we've just gone deep into 7 powerful dividend ETFs, each with its own strengths, yield profile, and market approach. But how do you use them together? Here's a smart diversification model for building a bulletproof dividend portfolio. 1. Base layer, stability and growth. SCHD, VIG and DGRO. These give you rock-solid dividend growth, strong long-term performance, and low volatility. 2. Yield layer. Consistent monthly cash flow. JEPI and JEPQ. Use these for monthly payouts and a yield boost. They provide smoother income with less market dependency. 3. Defensive layer. Protect during downturns. HDV great for market uncertainty, recession periods, or capital preservation. 4. Broad exposure layer, simplicity and balance. VYM use this as a simple, broad-based ETF that balances yield and diversification. This setup allows you to collect income every single month, maintain growth potential, and reduce risk. Want monthly income? Rotate JEPQ and JEPI. Want compounding growth? VIG and DGRO got you. Want a set and forget approach? SCHD and VYM make it easy. How to build a $10,000 dividend portfolio with these ETFs. Now, let's take a deeper dive into how you can build a $10,000 dividend portfolio using these 7 powerful dividend ETFs. This will give you a hands-on approach to building passive income that can grow over time. We'll split the $10,000 across these ETFs based on their characteristics and your investment goals, whether that's stability, growth, or monthly income. Step 1. Setting up the base layer, stability and growth. Let's allocate 40% of your portfolio into stable, long-term growth ETFs like SCHD, VIG, and DGRO. These ETFs are focused on strong, dividend-paying companies with solid financials. Example allocation: SCHD, $3,000. VIG, $2,000. DGRO, $2,000. Reasoning: these ETFs provide strong dividend growth and diversification. SCHD is ideal for consistent income. VIG focuses on companies with long-term dividend growth potential, and DGRO combines growth and income. Step 2. Monthly income layer, JEPI and JEPQ. Next, we'll allocate 30% of your portfolio to ETFs like JEPI and JEPQ, which focus on providing monthly income through option strategies. These funds are designed for people who need consistent cash flow and want to minimize market volatility. Example allocation: JEPI, $1,500. JEPQ, $1,500. Reasoning: both JEPI and JEPQ are built to provide monthly income using covered call options, making them perfect for investors who want to receive regular payouts. Step 3. Defensive Layer, HDV. To safeguard your portfolio during market downturns, we'll allocate 15% to HDV, the iShares Select Dividend ETF. This ETF focuses on high-yield, dividend-paying stocks, but it's defensive, so it can hold up well when the market faces volatility. Example allocation: HDV, $1,500. Reasoning: this allocation helps protect your portfolio in times of uncertainty. HDV's focus on high-quality dividend stocks with strong fundamentals provides more stability compared to high-growth options. Step 4. Broad Market Exposure, VYM. Finally, let's allocate 15% of the portfolio to VYM, the Vanguard High Dividend Yield ETF, which gives you broad exposure to large-cap dividend-paying stocks. VYM helps keep your portfolio balanced and diversified, ensuring you're not overly concentrated in one sector. Example allocation: VYM, $1,500. Reasoning: this broad market ETF is perfect for adding diversification, stability, and growth potential while maintaining a healthy yield. Reinvesting dividends, power of compounding. Now that we've allocated our $10,000 across these ETFs, the next important step is reinvesting dividends. By reinvesting the dividends you receive from these ETFs, you're essentially compounding your returns over time. Let's say you start with $10,000 and each ETF pays an average yield of 3% per year. Some may be higher, some lower, but this is a safe starting point. That's $300 in dividends after 1 year. If you reinvest that $300 into the same ETFs, your portfolio grows by another $300 in dividends the next year, creating a snowball effect. How reinvesting builds wealth. Let's do a quick example. Year 1. You earn $300 in dividends. Year 2. You reinvest those dividends, and now your portfolio is generating $309 in dividends. Year 3. Your reinvested dividends increase your total, now generating $318. And so on. This compounding effect accelerates the growth of your portfolio over time. You're not just earning dividends, you're increasing the amount of dividends you earn each year as your portfolio grows. Realistic income expectations and tax considerations. While dividend ETFs can provide impressive returns, it's important to set realistic income expectations and understand the tax implications of your investments. Realistic income expectations. Here's what you can expect for a $10,000 investment in these ETFs, with an average dividend yield of 3 to 5%. 3% yield. $300 per year in dividends. 4% yield. $400 per year in dividends. 5% yield. $500 per year in dividends. As you reinvest your dividends, your income grows year over year. But keep in mind that dividend yields can fluctuate based on the market and the performance of individual stocks in the ETFs. Tax considerations. Dividends are subject to taxes, but how much you pay depends on the type of dividend. Qualified dividends. These are taxed at the long-term capital gains rate, which can be as low as 0% 20% depending on your income bracket. Non-qualified dividends. These are taxed at your ordinary income tax rate, which can be higher than the capital gains rate. Keep in mind that tax rates can change based on government policies, and you should always consult a tax professional to ensure you're optimizing your tax strategy. Summary: building your passive income empire. Now you have all the tools to start building a $10,000 dividend portfolio. With strategic allocations to these 7 ETFs, you can create passive income that grows steadily over time. Here's a quick recap. Base layer, stability and growth, SCHD, VIG and DGRO. These ETFs provide consistent growth and long-term income. Monthly income layer, JEPI and JEPQ. These provide steady monthly dividends using covered calls and dividend strategies. Defensive layer, HDV. Protect your portfolio during market downturns with high-yield, stable dividend stocks. Broad market exposure, BYM. Diversify your portfolio across large-cap dividend stocks for stability and growth. By reinvesting your dividends and focusing on long-term growth, you'll tap into the power of compounding and create a growing income stream. Conclusion: by choosing the right dividend ETFs, you can achieve financial independence with minimal work. Whether you're looking for stable growth, reliable monthly income, or protection during market downturns, these ETFs have you covered. Start small, stay consistent, and let compounding work in your favor. Before you know it, your portfolio will be generating significant passive income that keeps growing without you having to do anything. If you found this video helpful, make sure to like, subscribe, and hit the bell icon to get notifications for future investment tips and strategies. Also, share your thoughts in the comments. Which ETF are you most excited to invest in? Let's continue the conversation and build a community of smart investors together.